Hi, welcome to the Crypto Republic. Before we begin today, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest tiny G updates in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at 10 a.m. and 2 p.m. Eastern Standard Time. And here at the Crypto Republic, we give you the bird's eye view, a satellite perspective to spot the big picture shifts while everyone else is stuck in the daily chaos. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Ladies and gentlemen, something just shifted around XRP. And if you're only watching the price, you're going to miss it because this isn't a breakout. It's not a headline. It's a change in how the system itself is starting to behave. Right now, quietly, regulators are adjusting, institutions are repositioning, and infrastructure is being built underneath the surface. And here's the part most people haven't caught yet. This shift doesn't look important at first, but once you see what's really changing, it's hard to ignore. Welcome back. If you've been here, you already know we don't chase noise and we don't react to every move. We track structure because in markets like this, short-term noise, long-term structure. Price reacts, but the system evolves underneath. And right now, something is shifting around XRP that doesn't show up clearly on a chart. To understand it, you have to zoom out because every real financial shift, every major one, starts the same way. Not with price, with infrastructure. Before the internet scaled, it was just protocols being built. Before electronic trading took over, it was systems quietly replacing old ones. Before major shifts in global markets, the groundwork was already in motion long before most people noticed. And that's the key, because what we're seeing right now looks small on the surface, but underneath, multiple pieces are starting to move at the same time. And once you connect them, the picture becomes a lot clearer. I just want to thank everyone that takes the time to like, subscribe, share, and comment on our videos. These few things really do help the channel grow. And with that being said, let's dissect this, and I hope you enjoyed content. How shifts begin. Every major financial transformation starts quietly. It doesn't begin with headlines. It doesn't begin with price. It begins with structure forming underneath. We saw it with the internet. We saw it with electronic trading. We saw it with global commodity markets. And now we're seeing it again. But it's here where it gets interesting. This time it's happening in digital assets. And XRP is sitting right in the middle of that transition. The regulatory shift, the real trigger. A recent report from the White House Council of Economic Advisors just changed something important. For years, the narrative was simple. Stablecoins could hurt banks. Yield could pull money out of the system. Regulation needed to be aggressive. But the data tells a different story. If stablecoin yield were banned entirely, bank lending would increase by about 0.02%. That's not meaningful. That's noise. And at the same time, consumers would actually be worse off. Less yield, less access, less innovation. Now, this is where it shifts, because for the first time, the data is pushing back on the narrative. What this actually means, this isn't just about stablecoins. This is about how regulators are starting to think. We're moving from fear-based decisions to data-driven evaluation. And where that shift begins, everything downstream changes. Most stablecoin reserves are still sitting inside the traditional banking system, meaning the feared bank drain isn't happening at scale. And this is what most investors are missing. If the core argument against crypto weakens, regulation softens, confidence builds, capital starts preparing. Here's the institutional shift. Now zoom into institutions, because this is where things get real. About 72% of finance leaders now believe digital assets are necessary to stay competitive. Not optional, necessary, but they're not ready. Because integration isn't simple, ladies and gentlemen. It requires compliance, custody, liquidity systems, risk frameworks, reporting infrastructure. And here's the opportunity. Demand is already here, but the infrastructure is still being built. Ripple, building the rails. Ripple's not focused on hype. They're focused on infrastructure. Let that sink in. Their strategy is integration, not disruption. Through solutions like Ripple Treasury, they are allowing institutions to plug digital assets directly into existing systems. No rebuild, no friction. And that's the key. Adoption doesn't happen when something is revolutionary. It happens when it becomes easy. Ripple also has the advantage of capital and time. They can build for the long term. XRP, the liquidity layer, Infrastructure needs a mechanism to move value. That's where XRP comes in. XRP functions as a bridge asset, a liquidity layer, a settlement mechanism. Think of it like this. If Ripple is building the highways, XRP is what moves across them. And this is where things compound. The more infrastructure that gets built, the more embedded XRP becomes in the system. XRPL ecosystem, the quiet build. Now zoom into the XRP ledger, because this is where real value gets created. We're seeing startups being built, applications launching, global development expanding. Every application creates activity. Activity creates demand. Demand creates value. And here's what people miss. Most people miss, unfortunately. Adoption is not an event. It's a process. The trust layer. Now let's talk about trust. Because without trust, institutions don't move. They need custody, security, clarity. We're also seeing a shift from trading to wealth management. Long-term thinking is entering the space. Retirement strategies, tax optimization, portfolio allocation. And this is where the game changes, because long-term capital behaves differently. The Clarity Act, the wild card. Markets currently see this as uncertain, around a coin flip, and markets move the most during uncertainty. Once something is certain, it's already priced in. Here's the macro connection. Short-term moves are driven by liquidity and sentiment. Long-term moves are driven by structure. So here's the final synthesis. Let's connect everything. We are seeing regulation shifting, institutions preparing, infrastructure building, ecosystems expanding, short-term noise, long-term structure, prices reacting, the system's evolving. So the final question, if even a fraction of global finance moves onto these rails, what does that mean for assets positioned at the center of liquidity? You got value from this. Like the video, subscribe to the channel, and drop a comment below. What do you think this shift leads to? Because at the end of the day, this isn't about hype. It's about positioning. And right now, something just shifted. And it may be bigger than it seems. Always pay attention to what's quiet, ladies and gentlemen. Always. Well, I hope everyone's having a happy Saturday. But you got to understand something right now as the negotiations are going on. Reports of 2 missile destroyers going through the straits and the Iranian Navy saying no, yes, all of this. Attacks still going on in Lebanon. There's a lot happening right now, ladies and gentlemen. And you got to understand something. The market is being moved by a perception. It almost wants everything to be over, but it's not. I want to welcome all the new members of the Patreon, all the new members of the membership channel. And I want everyone to understand something right now. And this is really, really important, because where we see the world going and where it's actually going are two different things. There's one school of thought that believes the disruption in the Middle East is to move all the crude oil exports out of the Gulf. We got to see if we're seeing any satellite photographs of VLCCs coming from there. But at the same point in time, we also have to understand, is there a bigger picture going on? That's my opinion. Is there a bigger picture going on right now? So when we look at the markets and we look at how everything is gelling, it tells a lot. If you're new to the channel, ladies and gentlemen, we go to rants, the second half. This is where you get the candy from the Italian ice. So if you're here, please do subscribe. I want to go over a couple key points right now, right, that we're paying attention to, okay? And this is important. Gold remains bullish post-war. Recent weakness equals temporary. So the target is still 5,100 near term and 5,800 year end. That's not noise, that's positioning guidance. The reality check almost everyone right now is operating under, that the war is over. We don't buy that. This is POTUS. Narratives can flip overnight. Fires can lead to escalation. Calm can lead to volatility. Stability can lead to repricing. Markets are extrapolating 2 weeks into 2 years. That's so dangerous. I mean, I was on the phone with the family office trying to explain to this how really dangerous this is. What this is really about, this is not just about oil, ladies and gentlemen. This is about the Strait of Hormuz. Again, the flow of capital, the structure of global settlement. Oil is surface level. The money flow is the real battlefield, ladies and gentlemen. So if you look at dollar weakness, this is the driver. This is the backbone. Structural dollar weakness leads to higher gold. And I'll say it clearly, 5 years from now, the dollar is going to be weaker versus gold. Why? The U.S. must export its way out of this situation. That requires a weaker currency. That means controlled debasement versus real asset, not financial advice, just my opinion, and anyone entertains any capacity. So if you look at gold, energy, commodities, all beneficiaries. So oil equals the pressure variable short-term dynamic. Higher oil leads to a stronger dollar. Stronger dollar leads to pressure on gold. Middle East may lead more dollars, slow gold buying if they need more dollars. But here's the line that matters, ladies and gentlemen. Write this down. Any shift in the petrodollar system would be supportive. Again, this is not a throwaway. That's the signal, ladies and gentlemen. Okay, so my take, this conflict is functioning as a quiet dollar intervention. And how it resolves, it bullish on gold, bearish dollar structurally. Magnitude is unknown, but the direction is clear. Ladies and gentlemen, the dollar system is having damage. It really, really is. You know, if you look at this, the dollar system is structurally weakening. Gold is stronger than dollar, valuation adjusted reserves. Central banks buying gold, not dollar dips. Let this sink in. That's massive. So the petrodollar recycling under strain translation, this is everything we've been saying for years. Again, gold as a neutral collateral, dollar losing marginal demand, flow shifting quietly. This isn't collapse, it's erosion. So the big picture, energy flows shifting, geopolitics fermenting, reserve behavior changing. This is how de-dollarization actually happens, ladies and gentlemen. It's not headlines. So if you look at this, equities are still taking in money. The policy is driving the market. So the risk is on. Regime shift underway. Globalism is leading to mercantilism, but the bulls are in control for now. So what matters, as long as equities, semis, and commodities hold highs, the risk stays on. But if the yield falls, leads to credit weakens, leads to risk cracks, credit always leads. So this is describing current positioning, not structural change. I'm trying to take the PhD out of PhD and giving you Clip Notes version of what's really happening around the world. And this is what everyone's looking, because gold is strong underneath. The dollar's under pressure. Look at the DXY. The system is shifting, yet flows are still risk on. The divergence won't last. Again, the moment some tweet comes out or if the markets are let down, we go right back to looking at the structural numbers of what's been damaged and where we really are. Again, I want to touch on silver for a second. Silver is very interesting right now. Silver is compressed. It's not trending. It's a tight range. Resistance plus supports are defined. It's a classic wedge formation. So if you're in metals, and we love metals, you trade the wedges. Again, not financial advice, just my opinion. The conditions of volatility high, prices erratic. It favors short-term trading, in my opinion, not clear trend behavior. So here's a key insight. Silver's behavior, the upside right now is acting like copper. The downside's acting like gold. So the weak dollar leads to copper, leads to silver flows. A strong dollar leads to gold pressure, leads to silver follows. It's not leading, it's reacting. So if you look at CTAs, they're selling weakness. There's limited buying right now because they understand things can change in a dime. So if they want upside, they're going to buy copper harder. So silver stays sideways, in my opinion, not financial advice. It's not bearish, it's not bullish, it's compressed, and compression leads to expansion. So that's really, really important. Ladies and gentlemen, like I always say, one tips from the pits can pay for your entire year subscription. If you want to see how we take all of this and apply it to the macro research, do come and join over 500 active traders, investors inside the Crypto Republic Desk monthly and see how this all translates to. Again, welcome everyone here. Ladies and gentlemen, Deutsche Bank published a report on the 10th. And they're going over a lot of things. And they're quietly re-engaged in gold coverage, particularly following their interactions in China. Their approach has been consistent, measured, data-driven, supportive without exaggeration. Their last report continues at the pattern, but with a noticeable shift in confidence. So in our opinion, they're looking at the current environment and leaning towards the view that the worst of this phase is behind us. They won't say that outright, but the implication is clear. The key point is straightforward. The gold outlook remains constructive following the conflict. Recent weakness is viewed as temporary. A combination of de-escalation and macro tailwinds could push gold meaningful higher into year-end. That's not casual commentary. That's positioning guidance. However, I would want to be very clear about one thing. Much of what we're discussing and reading about from the board right now is built on the assumption that the conflict is effectively over. I'm not convinced that's a safe assumption. Again, the situation remains fluid, and the geopolitical backdrop can change quickly. Markets are taking short-term stability and projecting it far into the future, which historically tends to create mispricing. Again, you got to make sure you don't get cut up like sushi here. We will not get cut up like sushi. We got the Gucci conviction here. So from my perspective, the real focus isn't just oil. It's the broader system surrounding it. The conversation is shifting towards the flow of capital through critical channels, particularly areas like the Strait of Hormuz. This is less about energy in isolation and more about how value moves through the global system. Where we do agree with them is that the reports on the dollar. Structural pressure on the U.S. dollar is the core driver here. So if you extend the view over a longer horizon, the dollar and the belief in the dollar will be materially weaker against real assets like gold over the next several years. That outcome aligns with the broader need for the U.S. to rebound through exports, which inherently requires a softer currency. Oil in this context becomes the key short-term variable. Elevated energy prices can contemporarily support the dollar, which in turn can pressure gold. So in those periods, countries that rely on dollar liquidity may need to prioritize access to dollars over continued gold accumulation. But the more important point, and the one that stood out the most, is the acknowledgement that any shift in the petrodollar system will be supportive for gold. This is a significant statement, ladies and gentlemen, not financial advice, just our opinion. It implies that how this situation ultimately resolves could have lasting implications for the monetary system, not just the commodity markets. So if you look at the flow side, the picture is stable. ETF flows already stable, positioning is balanced, and central banks continue to accumulate gold. There's a new world. This is not speculative behavior, ladies and gentlemen, the structural demand. So the dollar system is undergoing a structural weakening, ladies and gentlemen. This is important, and recent geopolitical developments have accelerated the process. Several key points emerge. The dollar's dominance is gradually eroding. Gold is overtaking the dollar on a valuation-adjusted reserve basis. Central banks are shifting behavior, reducing reliance on dollar dips and steadily increasing gold allocation. The petrodollar is a recycling mechanism. It's under increasing strain. So from my perspective, this is a clear validation of a framework we've been discussing for some time. The relationship between gold and the dollar has changed, and it's unlikely to revert to prior norms without a significant reset in pricing. What we're seeing now is a gradual reallocation towards neutral reserve assets away from political exposed ones. So importantly, this isn't happening through abrupt decisions, ladies and gentlemen. It's not. It's happening through incremental changes in behavior, and those changes compound over time. So the key premise is that policy remains the dominant force in markets. This is so important. Again, this is what you see, why we say tweets move markets. This is it. This continues to be true. Liquidity conditions, fiscal decisions, and geopolitical developments are all shaping price action more than traditional fundamentals. Flows for now remain risk-on. Equities are holding. Semiconductors are stable. Commodities remain elevated. That tells me that at the surface level, the system hasn't broken, but at the same time, the broader regime shift is still underway. We're moving away from globalized, efficiency-driven model towards one that prioritizes natural interest, regionalism, resilience, and control over resources. So the main risk signal to monitor here is credit. If yields begin to fall in a way that reflects stress rather than easing and credit markets weaken, that would likely be the trigger that shifts broader markets' behavior. And again, what I said before, silver is currently in a compressed range. Price is not trending. It's consolidating within defined levels, forming what is effectively a tightening pattern. These types of structures typically resolve in a decisive move, but the timing that move is less important than recognizing the setup. So volatility remains elevated, which makes directional positioning more difficult than favors short-term strategies. So from a macro perspective, not financial advice, that's my opinion, silver is behaving less like a standalone asset and more like a proxy. It tends to follow copper in stronger risk-on environments and align with gold during periods of dollar strength or defensive positioning. That dynamic makes it reactive rather than leading. So positioning reflects that indecision. Flows are neutral, with limited conviction on either side. In my view, this is not a trend, it's a period of compression out of expansion. Ladies and gentlemen, this is exactly what I'm talking about. One good tip from the pits can easily pay for your entire year's subscription. If you want the deeper macro research and, more importantly, how to actually position around all this, come and join us. We're approaching over 500 active traders and investors inside the Crypto Republic Desk monthly. Welcome all new members. Ladies and gentlemen, the world is changing right now. I can't wait to see what it says out of the weekend, but at the end of the day, there's so much happening. I mean, I'm following a big thing also. I'm following right now stablecoins, Russian stablecoins in Africa. That's massive. But these are the flows that are pushing everything. Because right now, to not get caught up like sushi, to have that Gucci conviction, that Gucci clarity, again, as the remora. Why I said that we're in carnivorous mode right now, because we're taking advantage of everyone who's not prepared for these markets. They're not. Just because you work at some big bank, or I remember on the Mercantile Exchange, if just because on your jacket it said some bank name, doesn't mean you were King Farouk and some genius. No, does it? When you put the hard work and the heavy lifting and you understand and you're dialed in, that's where it makes a difference as far as I'm concerned. But everyone's talking about oil right now, but all they're saying is the same thing: geopolitics, uncertainty, tension. That's surface level thinking, because what nobody's doing right now is actually quantifying the damage. And when you quantify it, you realize something very uncomfortable. This is not volatility. This is a structural supply shock. Let me show you what the market's missing right now. Stay with me. Not opinions, not narratives. Numbers, real capacity, real outages, real timelines. The previous video, we went over everything about LNG and the trains that are damaged. Once you see the numbers, you'll understand why crude moving above 100 isn't the story. It's the warning. Over the last 6 weeks alone, more than 60 energy infrastructure assets have been hit. Let that sink in, ladies and gentlemen. Not one, not two, not isolated incidents, 60 plus assets. And out of those, roughly 50 sustain actual damage. Here's where it gets really interesting. Most headlines stop there. They say facilities hit, operations disrupted. But that tells you nothing. Ungats, you get nothing from that. Because in commodities, damage without scale is meaningless. So let's quantify it here right now, because this is where the entire narrative breaks. Again, the refining capacity shock. Right now, 2.4 million barrels per day of refining capacity has been shut in. That's not a small number. That's a system-level disruption. Breaking that down, 100,000 barrels per day, 900,000 barrels per day could retreat in weeks. 800,000 barrels per day, about a month. 700,000 barrels per day, long-duration damage. And that last segment, what I just went, that's where the market is completely mispricing risk, because markets are forward-looking, but they're not forward-thinking. Again, let me throw in the contrarian angle here. Everyone assumes supply comes back. Like, that's it. Time out. All is good. All is well. Flip the switch. Turn the oil back on. It doesn't work like that. But again, everyone assumes supply comes right back, right? But what if it doesn't? What if it doesn't? Or worse, what if it comes back slower than demand tightens? Demand destruction could come. Critical infrastructure got hit. Let's go deeper. Stay with me, because this isn't just refineries. This is system plumbing. The East-West pipeline in Saudi Arabia, 7 million barrels per day capacity, and it just lost 700,000 barrels per day of throughput from a single attack. That pipeline is critical. It bypasses choke points. It stabilizes flow. It's not optional infrastructure. And now it's compromised. It got attacked. So now ask yourself, if one pipeline hit removes 700,000 barrels BTB, what happens when multiple nodes fail simultaneously? Field level disruptions. Let's go upstream, because this is where things get even more serious. Iran South Paris phase, 944,000 barrels per day shut in. Iraq's Marilla field, 1 million barrels per day disrupted. Saudi's fields like Manifa and Karis, hundreds of thousands of barrels impacted. This is not localized, ladies and gentlemen. This is across region, multi-country, simultaneous disruption. Do you realize how crazy this is? If you write all this down and you go look this up, everybody in the Patreon, the Crypto Republic Desk Monthly, don't worry, we're doing this for you. This tells you where to trade and what to do. It leads you the trail. It's like a treasure map. We're giving you our research that could really, really help you if you understand how to read this treasure map. But you're looking at simultaneous disruptions. So the big picture shift here, this is the part retail never sees, ladies and gentlemen, unfortunately, and why people get caught up like sushi. Even CTAs get caught up like sushi. They look at the price. We look at flow capacity, degradation. That's what we look at. And those are two different things. Again, so if you look at the LNG and gas, this is a silent shock. Here's the part that almost nobody's talking about, gas. We spoke about that last video. Because oil gets headlines, but gas breaks economies. Qatar's LNG infrastructure, multiple trains hit. We're talking 5 million tons per annum offline in one unit, 8 million tons per annum in another. Here's the key detail: long repair timelines. Ladies and gentlemen, if you want to see all this information, do go see yesterday's video. Go to the rant. You'll see me go off on this around like minute 20, 25. Long repair timelines. This is the key detail. That's not weeks. That's months. That's potentially years. So think about this globally. Again, Europe still depends on LNG flows. Asia's competing for cargo. Supply just got structurally tighter. So the false narrative temporary is so misleading and dangerous. Yesterday, people were celebrating a ceasefire. But here's what actually happened. Within hours, critical infrastructure was hit again. This is the illusion of stability. Markets love headlines. But infrastructure damage doesn't reverse with diplomacy. It doesn't. You can announce peace, ladies and gentlemen. You cannot instantly rebuild a refinery. Again, so the timeline problem no one wants to talk about. This is the core of the entire thesis: time. Not just damage, time to repair. because here's what we're seeing. Some capacity leads to weeks, some months, some multi-year rebuilding cycles, ladies and gentlemen, and markets are pricing weeks. So the gap between reality and expectation is where you find the alpha. That is where the opportunity is. This is where the edge is, ladies and gentlemen. Let's take it one level deeper. Stay with me here, because this isn't just about supply loss. This creates logistics bottlenecks, storage imbalances, refining margin distortions, regional price dislocation. For example, when a refinery capacity drops, crude doesn't just go up. Product spreads explode. Diesel, jet fuel, gasoline. That's where the real money flows. Again, so this is the layer most people never even look at. Again, they're trading headlines. Others are trading flow dynamics. Why $100 is just the start? Let's talk about price. WTI above 100, that's not extreme. If anything, it's conservative, because when you stack 2.4 MBD refining offline, 700,000 pipeline disruption, 1.2 MBD upstream instability, LNG constraints, you're not in a balanced market anymore, ladies and gentlemen. We're not in Kansas. You're in a tightening spiral. And tight markets don't move gradually, they move violently. This is the real risk nobody's pricing in. Here's the real risk. Now, what's already damaged and what hasn't been hit yet because the system is now exposed, we've seen pipelines, refineries, fields, LNG terminals, everything is targetable. They're targeting everything. So the question isn't, is supply disrupted? It's how much more can be disrupted. Let that sink in. So if you look at the market psychology of this, markets are still anchored in, they believe this will normalize, this will pass, this is temporary, blah, 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 blah. But every data point says the opposite again. And this is where positioning matters, because by the time consensus realizes, the move is already gone. So the difference right now, again, isn't access to information, it's interpretation, ladies and gentlemen. Anyone can read headlines. Very few people can break down capacity loss, reserve curves, flow disruptions, second-order effects. And that translates into positioning, ladies and gentlemen, because once you start thinking in systems, you start reacting and you start anticipating. So let's bridge this together. We have multiple region infrastructure damage, measurable supply loss, uneven recovery timelines, continued geopolitical risk, and a market still underpricing, duration. That combination is extremely rare. And moments like this don't just move markets, they define cycles. So the real question you should be asking yourself is oil going higher? It's, do I actually understand what's driving this move? Because if you do, you're not reacting to price, you're ahead of it. And right now, the data is telling a very clear story. Most people just aren't reading it. And this is exactly what I'm talking about. Ladies and gentlemen, one good tip from the pits can easily pay for your entire year subscription. If you want the deeper macro research, and more importantly, how to actually position around all this, come and join us. We're approaching over 500 active traders and investors inside the Crypto Republic Desk Monthly. Welcome all new members. Ladies and gentlemen, this is what's happening right now. The math tells a story. I mean, I don't even know how to really quantify how bad the damage is. I don't expect this to go away anytime soon. I expect this to be a controlled narrative. That's just my opinion. I really expect a controlled narrative right now. People need the stock market higher to win elections. I get it. You need stability to get interest rate cuts. I get it, right? What happens if this is just being done? This is my opinion, right? As a financial mercenary, I'm looking at this right now, that this trading time situation we're in is going to be with us a lot longer than most people realize, honestly. And if you look at historical relationships, oil and gold have had a relationship. It's not perfect, but it's directional. But that relationship is breaking down in real time. We saw it. So you can see what's happening. But is this a controlled destruction on purpose? That's what I'm trying to sit there and get at. And why I'm saying this is because what happens if all the VLCC traffic is going to be diverted to the Gulf? And if people say, if we can't get oil out of there, you can. There's places right now, we have someone that works for us that couldn't get on a plane in Spain. They had to wait 9 hours for their plane because there wasn't enough jet fuel. 9 hours. I mean, that's insane. But that's what's happening. You got countries rationing energy right now. So ask yourself this. We are behind enemy lines now with this financial war that's going on. Unfortunately, it's happening to everyone. Ladies and gentlemen, what if this is all done on purpose? That's why when I get back to XRP, ICP, HBAR, the world is being changed. Everything is changing in front of us. You can take the old rule book and throw it out. I just see the trading environment that we're in right now going on for a lot longer than most people understand. I don't see how they're going to allow a toll to be charged. I don't see how you can get away from economic numbers. Look, I had a long conversation before filming this video with a very, very, very old, powerful family office and the family behind the office about how we don't even think that the economic reports are even read any longer the proper way, how they price in. If you look at economic reports, how they're priced in, and if you look at the inputs and outputs of commodities, how it was done 50 years ago tells a different tale to how it's done now. But again, we watch the DXY, watching gold, watching crude oil, watching the narrative. But in this era of a tweet moving everything, one tweet, we could be back to dropping bombs. Nothing stopped. We went over everything here. And as a mercenary financially, we have our playbook that we're going to run day in, day out, because this narrative now is we're dialed in carnivorous mode. So again, if you want to stay ahead of how all this evolves, this is exactly what we're tracking inside the Crypto Republic, ladies and gentlemen. The Crypto Republic desk, real-time shifts, positioning, and how to navigate as unfolds. The goal isn't to react, it's to be positioned before the move. I keep telling you this. One good tip from the pits can easily pay for your entire year subscription. If you want the deeper macro research and learn how to take advantage of all this, come and join almost 500 active traders, investors in the Patreon, the Crypto Republic Desk Monthly. Ladies and gentlemen, my vantage point is this. We're going to take advantage of the chaos that's man-made, because there are people, everyone always complains that there were people in higher official, whatever roles they were, that did trading one way or another and they took advantage. Why don't you want to take advantage of what's happening right now? If someone could show you the way, if someone could turn on that lighthouse and guide you in of how this is happening, if you want to understand this, come and join us, because right now, to me, we will look back and the chaos that is being created right now is going to create retirement opportunities for people who understand how to trade this in some capacity. It's not financial advice. It's just my opinion for the environment that we're in, because this is going to go on over and over again. This Harry Houdini freak show that we're in is not going away anytime soon. It's just not. So learning how to play this is the most important thing. Learning how to capitalize off this is the most important thing. Because ask yourself this, right? Do you realize what's coming and why the dollar has to be weaker to export out of this? Do you understand that? Why things have to happen? People talk about flipping a switch. I was never one of those people flip a switch. I don't understand that. Maybe someone can explain that to me in the comment section. My switch being flipped is watching how a country economically gets out of a scenario that there's only one or two ways of rooted economic theory out of it. That's right. Because we're not going to get cut up like sushi. We're not. And that's the most important thing. I want you to understand something, right? Because look at yourself this. Does anyone really think that there's going to be peace? How? How? I don't understand this. I don't. Why I say this is because you have people dug in now. When people are dug in and we're in the middle of no man's land, ain't going to be peace. I can't see it. And when I don't see it, I call it as is. That's why we're in carnivorous mode. We're trading the situations that we understand. Again, we understand the who's, the whys, the whens, the price levels, the major supports, the major resistance levels, all in between. The derivative plays that we take advantage of. The equity plays further downstream. The commodity plays. What futures months? Again, playing all this together. Again, and we will look back, and people who took advantage now to accumulate alpha through trading through these scenarios and DCA'd with the crypto assets, the anointed one, XRP, ICP, HBAR, XLM, XDC, will take advantage and ride this generational wealth train to where it may go. Ladies and gentlemen, this content is for informational and entertainment purposes only and should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions always. Remember, the game is changing, and those who understand it first will benefit the most. Make sure on the right side of it, you have two choices. You can be like the crowd, reacting after the move, rationalizing why they missed it, telling themselves they'll never let it happen again, or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet right up until the moment they're not. And this is one of those moments. Do not blink because the world is distracting you with noise while XRP continues developing behind the scene and building momentum in the broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. Your move now will be remembered. It's not the end of the story. This is just the beginning. This opened your eyes. Smash that like button, ring the bell, and leave a comment with your thoughts. Turn on notifications. The most important, subscribe to Crypto Republic. We break down the major global banking trends shaping digital assets today, giving you context, clarity, research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the Republic. I love you all. Have a blessed weekend.